I open up YouTube. I type something simple like profitable trading strategies, and almost immediately I get flooded with thumbnails. 80% win rate, 90% win rate, 75% win rate. Over and over again. And almost instantly, there is this dopamine hit. Something inside me that says, click that. Because if there is an 80% win rate strategy out there, why would I not want that? 10 trades, 8 winners, 2 losers. Sounds amazing, right? Sounds efficient. Sounds almost certain. And certainty is very attractive. That is what pulls us in. But over the years, whether it's my engineering brain or just years spent on the markets, I've become very skeptical of these claims. Not because high win rates are impossible. They're not. But because they're incomplete. And incomplete information in the markets is very dangerous. Still, the funny thing is that even knowing all of this, the algorithm sends me another one and another one, and I still feel tempted to click. And that's when I realized something. It's not just the algorithm, it's the human psychology. We're very deeply attracted to winning percentages because win rates feel like certainty, and certainty feels like safety. But the market doesn't reward certainty. The market rewards an asymmetric outcome. And there is a huge difference here. Think about it like this. Imagine you have a bridge. And if that bridge successfully passes 90% of all of the load testing, but it fails catastrophically on 10% that matter the most, do you think that's a good bridge? Of course not, because those failures can carry massive consequences. In engineering, success rate alone means nothing. Failure modes matter, magnitude matters, consequences matter. In trading is no difference. A strategy that can win 80% of the time can still lose money. Why? Because if the losses are structurally larger than the wins, then the math eventually catches up. And that math is very simple. Expectancy is equal to win rate multiplied by the average win minus the loss rate multiplied by the average loss. That's the real equation. It's not win rate, it's expectancy. That's what determines whether a system survives. So why do people fall for win rate so easily? Because the human brain loves the frequency more than the magnitude. 5 wins feel amazing. 8 wins feel even better. And 2 losses? Well, it doesn't sound so bad until those losses erase all the wins you've made in the previous 8 trades that you made. And that's the trap. Humans count events. Reality weighs consequences. And those are 2 very different systems. Even on my own channel, I've talked about win rates. I've shown examples where a strategy delivered 80% win rate over a 6-month period. And that is true, but it's true with a limited sample size. And sample size matters as well because data without enough scale can fool you too. 6 months is data, but is it enough? What about 1 year? What about 5 years? What about 10 times the number of trades? Would that win rate still hold? Maybe, maybe not. And that's where the problem lies. And yes, you can backtest, and I actually encourage it because backtesting has a lot of value. It helps you build the confidence. It helps you understand the pattern. It helps you really double click on a strategy. But you need to be honest with yourself. Backtesting is not reality. Backtesting removes the emotions. It removes hesitation. It removes fear. It removes you being distracted, or it ultimately removes life and life things, circumstances that are happening. So things like when you feel stressed, when you had a bad day at work, when your child woke up at 5 a.m., when you felt distracted or you were tired and emotional. And that exactly is what trading is. It's not clicking through candles in hindsight. In backtesting, every candle is obvious. In real life, nothing is obvious. Think about it. A candle takes an entire day to form for a daily candle. On a backtest, it's just a single click. So real-time execution is the truth because execution changes everything. So what do? Do you ignore win rate completely? No. I mean, win rate does matter, but it's only one variable. What matters more is asymmetry. And asymmetry is what I build my strategy around. Not complexity, but simplicity. Because complexity creates more failure points. And as an engineer, I know this because the more variables you add to a system, then you add more ways that the system can fail. Simple systems are easy to test. It's easy to analyze. And they're easy to understand. And they're easier to repeat. And repeatability is where the edge in trading lives. My strategy is very simple, and it is intentionally so. I always start with a monthly time chart. Always. Why? Because the monthly chart removes noise. It gives me structure. It tells me where the price is in a larger cycle. And most importantly, it helps me identify when a price has reached some sort of discount level. That discount level is what I call a demand zone. Not a premium, a discount level. Why? Because when you buy at a discount, you're naturally asymmetric. If price is already extended near the top of its range, then your upside shrinks and your downside grows. And that's a bad asymmetry. What I want to do is I want to do the opposite. So I wait. I let the price come to a discount level, to a demand zone. A place where buyers have shown strong interest in the past. A place where some sort of imbalance exists. A place where price previously moved very aggressively. And that's where I pay attention, but I don't enter there blindly either. I very often go to a lower time frame on the daily time chart because location is not enough. It is on the daily time chart where I look for a confirmation. What kind of confirmation? A breakout, a break of consolidation in a specific region where three different EMAs are very close to each other. And that to me is the trigger when the price breaks out of this consolidation. And then I manage the risk because my stop is defined. My invalidation is clear. My upside is larger than my downside. Now I can risk 1 unit to make 2 or 3, sometimes even more. And suddenly I don't need a clickbait win rate like 80% or 70%. I don't need it at all. If I can risk 1 to make 3, I can be wrong more often and I can still win. And that changes the whole game because now I'm not trying to be right all the time. I'm building a system where I can afford to be wrong. And that's the goal. It's not perfection, it's survivability. It is discipline and consistency because survival gives you time and time allows your edge to play out. Not because simple means easy. Simple is hard. Simple does require patience and it requires a lot of discipline. And simple requires you saying no. But simple survives reality. And in trading, that matters more than you looking good on paper. So next time you see a thumbnail where it says 90% or 80% win rate or guaranteed setup, do yourself a favor and ask the better question. Not how often does it win, but ask when it wins, how much does it make? And when it loses, how much does it actually cost you? Ask the question, how specific were they when they calculated the win rate? How realistic was their execution? What about the fees, the slippage that happened in the markets? Because markets don't pay you for being right often. They pay you for being right efficiently. And that's a very different game. Thank you again for your attention, and until next time. Bye-bye.